A new era of regulation. SEBI's intervention in the F&O market. The Securities and Exchange Board of India, or SEBI, introduced significant regulatory changes to the futures and options market in mid-November 2024. This marked a new era for derivatives trading in India. These changes were aimed at curbing excessive speculation, particularly among retail investors. SEBI's intervention signaled a shift towards a more regulated and potentially less volatile derivatives market. One of the key changes involved limiting the number of contracts traders could hold on a single exchange. This measure directly targeted large-scale speculative positions that could amplify market swings. Additionally, SEBI increased the minimum contract size for index derivatives to 15 lakh rupees. This higher entry barrier effectively excluded a significant portion of retail traders who were unable to meet the increased capital requirements. The regulatory overhaul sent ripples through the market, prompting a period of adjustment for traders and investors alike. The long-term implications of these changes on market dynamics and investor behavior remain to be fully understood. However, the immediate impact was undeniable, leading to a notable shift in trading patterns and participation. The numbers tell the story: declining volumes and retail retreat. The impact of SEBI's new regulations was immediately reflected in the trading volumes of the F&O segment. Data from the National Stock Exchange paints a clear picture of the decline. In October 2024, before the regulations took effect, the average daily turnover for index futures stood at 34,600 crore rupees, while index options reached 3,90,098 crore rupees. By January 2025, these figures had plummeted to 29,802 crore rupees for futures and 1,97,056 crore rupees for options. This downward trend was consistent throughout the months following the implementation of the new rules. The decline in trading volumes was accompanied by a noticeable retreat of retail participants from the F&O market. The increased minimum contract size proved to be a significant barrier for many retail traders. Many were either unwilling or unable to commit the higher capital required to participate in the F&O segment. This exodus of retail investors contributed to the shrinking volumes and signaled a potential shift in the market's participant profile. Thursday expiry, a move towards stability or predictability. In a move aimed at reducing volatility and curbing speculative trading, SEBI limited the expiry of weekly F&O contracts to Thursdays only. Previously, contracts expired on different days of the week, creating more opportunities for short-term speculation. This change, while seemingly technical, has had a profound impact on market behavior. The Thursday expiry has introduced an element of predictability into the market. Traders now operate within a tighter time frame, leading to concentrated trading activity around the expiry day. This concentration has, to some extent, stabilized price movements, particularly in highly volatile segments like Bank Nifty futures. However, it has also raised concerns about potential manipulation and increased risk on Thursdays. The long-term effects of this change on market efficiency and price discovery are still under debate. While it has arguably reduced short-term volatility, some argue that it may have also reduced market liquidity and increased the potential for price shocks around expiry days. NSE's balancing act, expanding opportunities in a shrinking market. Despite the overall decline in F&O trading activity, the National Stock Exchange took a seemingly counterintuitive step, adding 6 new stocks to the F&O segment. The new additions include Castrol India, Gland Pharma, NBCC, India, Phoenix Mills, Solar Industries India, and Torrent Power. This move has been interpreted as an attempt to counter the shrinking market by offering traders a wider range of investment avenues. By introducing new stocks to the F&O segment, NSE aims to attract fresh capital and diversify trading opportunities. This strategic move suggests that while SEBI's regulations have undoubtedly impacted market dynamics, the exchange remains committed to ensuring the growth and vibrancy of the Indian derivatives market. Whether this expansion can effectively offset the decline in trading volumes remains to be seen. However, it underscores the evolving nature of the Indian F&O market in the face of regulatory changes and shifting investor sentiment. The future of the market will likely be shaped by the interplay between regulatory measures, market forces, and investor adaptation.